For those of you who don't know me, my name is David Lappert. I work for Kravit. I'm the president of the ITA board. And I want to thank all of you for taking the time to join this biannual meeting of the International Textile Alliance. These meetings are required in our bylaws. And it is a good biannual event so we can give you, our member companies, who are the backbone of ITA, information on what we're working on, as well as information around the upcoming trade show, which is obviously the highlight of our calendar twice a year. Carrie and I are going to keep our portion of the meeting brief because we have a very distinguished guest speaker today who has much more intelligent things to say than I do. And you're going to enjoy your time listening to him. We'll talk about Mr. Vittner, who will join us in a few minutes here when his time comes to speak. But it's an honor that he would spend time with us at our meeting. So as I said, I'm David Lappert. I'm joined by Carrie Dillon, who is the managing director of ITA and who does such a great job managing the organization. Our organization is made up of a volunteer board, as many of you know. On the screen now, you will see the current ITA board. Again, these are all volunteers who volunteer their time, energy, experience to improving our organization, growing our organization. You know, without the volunteer board, the organization would not exist. So thank you to all of the board members for your dedication to our industry and to improving our industry for all the ITA stakeholders, both the members who are the exhibitors and the buyers who attend our trade show. We also have a small but powerful staff. Carrie, who I just a few minutes ago introduced, who is the managing director, who has been with ITA for quite some time now, does a great job, and she is joined by Abigail Felton, who has been with us for a couple of years now, and handles more of the operational side of the office and the day-to-day operations of the organization. And she has been just a pleasure to work with since her time with ITA.
We also wanted to take a minute to recognize all of the additional volunteers that support ITA through their participation in a number of different committees. This is certainly not the entire list. We have also the DEI Committee and Educational Foundation Committee and our Young Textile Professionals group. But we are very grateful for all the support of the volunteers that support this organization. So one new announcement for this show, based on feedback from the buyers, we have adjusted the hours on the pavilion floor, which is our temporary floor on the 5th floor of Market Square. Those hours beginning next week will be Tuesday and Wednesday, 9 a.m. to 5 p.m. and on Thursday from 9 a.m. to 2 p.m.
We have some really exciting potential news for ITA. As many of you know, we moved the pavilion floor to the 5th floor of the tower a couple years back. There's been some very positive feedback, but there's also been some not so positive feedback about the 5th floor, the layout of that floor, the proximity of the floor not being front and center for the buyers to locate that floor. And so we started to explore other options with our landlord partners at Anmore. And if we haven't said it already, and we can't say it enough, they're great partners that we are honored to work with. And we've identified an area of the 2nd floor very near the entrance of the tower on the 2nd floor But in the historic part of the building, over by the String and Splinter Club, there is lots of open real estate in the building, which we believe would make a more beneficial location for the pavilion floor. Much higher foot traffic. It's a much cleaner space. It's not so chopped up like the fifth floor. It has that very idyllic charm of the older part of Market Square. And if you are a member who not only exhibits at Interwoven, but if you also have a trade program and you have an existing trade program that sells to the interior design trade, there will be the opportunity for that member to open up during both April and October furniture markets. We've set 2 time slots aside to show the space to the members that are on the pavilion floor, or any member that would like to join the tours. We're going to do that Monday at 2 p.m. and Thursday at 11 a.m. We believe that the feedback that we will get from our members will be very, very positive. So we're excited about showing that off. And the reason I say potential new location, in all transparency, we do not have a written agreement signed, sealed, and delivered with Ann Moore, although we have very high confidence that we will get that done if there is the continued motivation to move to the second floor. So we feel comfortable enough to present the potential new location to you, our ITA members.
And with that, we're going to jump into a few updates for next week's show. But before I do that, I want to take a moment to thank our sponsor members, which include Krypton, Cotton Incorporated, and Lensing Fibers. They provided the financial support to help make the show as successful as it is. And want to make sure that we highlight them and thank them for that support. A quick update on the number of exhibitors. There will be a total of 111 exhibitors next week, with the majority being in the Market Square complex. We have 83 members there, 16 in the Home Fashions Resource Center and the Resource Center. 7 of our members are in standalone showrooms throughout the city, and 4 in Congdon Yards. And so as a quick reminder, we do have 2 shuttles that run continuously throughout the downtown textile district, and can get you to any of these buildings. You can find that information on the website. Want to take a moment too to recognize some of our new members for this fiscal year. We are, always excited to have new members join the association, and I hope that as ITA members, you will welcome them, and as ITA buyers, you'll take a minute to see what they have to offer. Another exciting change for this show is the move of a few of our education, our trend display, and social gatherings to the factory, which is located at the Market Square courtyard entrance. Here, as I mentioned, we will be hosting our education. Want to just highlight real quick what we're offering this show, because we're very excited about what we have in store. So on Tuesday, May 20th at 12 p.m., we'll have a lunch and learn sponsored by Cotton Incorporated, where the panel will be discussing the future of natural fibers in home interiors. That panel includes Karen Fugel from Libico, Scott Kahn from Regal Fabrics, Millie Solomon from Kufri, and our moderator is Marcy Gang from Cotton Incorporated. We do ask that if you plan on attending that and having lunch, to please RSVP so we can make sure that we have a lunch for you. And Abigail will put that link in the chat, and it can also be found on the schedule of events online. And then at 4 p.m. on Tuesday afternoon, we'll have our trend forecast presented by Kristen Moonjian with Future Snoops, formerly Fashion Snoops. They're our trend forecasting partner. I'd encourage you to come early to this event. We will be offering coffee, wine, and beer in advance of this event, because it will roll right into our social event that evening, which I'll get to in just a moment. But to finish the education for the week, on Wednesday at 11 a.m., we are looking forward to a presentation from Lensing Fibers, where we'll be discussing sustainability and innovation in textile manufacturing. Our panelists include Holly Fulton, Donna Morrison, and Jenny Tinsley from Culp. And this will be moderated by Walter Brigham of Lensing Fibers. And then at 1 p.m., we have a great panel of textile artists talking about the art of sustainability, handcrafted textiles, and conscious design. Our panelists for this event include Caroline Cecil with Caroline Cecil Creative and Caroline Cecil Textiles, William Storms of Studio Storms, and Millie Sullivan of Kufri. And this will be moderated by Jay Anamize from Future Snoods. One of our speakers from that last presentation, William Storms, who is a former ITA member, worked for some member companies, and a very successful artist. Now he actually designed the art that you'll see on the cover of the upcoming magazine. And we're excited to have one of his pieces on display also in the factory. So please make sure you get down to see that, and hopefully you can join the talk at 1 p.m. on Wednesday and speak to William and the other artists as well. And as I mentioned, our trend gallery will also be right outside of the factory, which again is located at the Market Square courtyard entrance. I do want to take a minute to thank STI Fabrics for their sponsorship of the trend education, and also thank our partners, which include the High Point Market Authority and more, and the American Home Furnishings Hall of Fame, who we partner with to bring this valuable information to our members and the buyers. And as I briefly mentioned earlier, following that 4 p.m. trend presentation on Tuesday, we will host our networking cocktail with the theme actually comes from one of the trends being presented at the 4 p.m. seminar. And so we'll have a nice Palm Springs retro vibe. And so please come, bring your customers, stop by, have a drink and a snack before you head off to dinner. This is also sponsored by STI Fabrics and more. So we certainly want to thank them for that sponsorship. And the social event will be under the water tower, which is accessible through the factory restaurant. So please make plans to stop by. It's a great opportunity to network with fellow members and the buyers attending the show. And then on Wednesday night, our young textile professionals will be meeting at Brown Truck Brewery from 5 to 7 p.m. This is a great opportunity for those newer to the industry to meet one another. It's always a great event. So if you have younger people in your organization, please make sure they're aware of this and encourage them to attend. We are very excited to offer a special event on the pavilion floor, which is again the 5th floor of Market Square. Our Pop Fizz and Fluff champagne and cotton candy event is sponsored by Pressmont Fabrics and will be located at their booth, which is booth 519 on that pavilion floor from 2 to 4 p.m. on Tuesday, that first day of the show. So please come upstairs and have a little champagne and cotton candy and say hello to our friends at Crestmont. And while you're on that pavilion floor, I just mentioned the Pop Fizz and Fluff event. But while you're there, we also have on display the Virginia Jackson Design Competition, which is a competition that multiple textile design schools participate in. There are submissions in print, Dobby, and Jacquard categories. And we had a group of talented judges from the industry review these during Furniture Market and select winners in each category. So not only are all the submissions on display, but you'll also be able to see the winning entries along with those schools and students. So please take a moment to see what the future holds for our industry. And then we also offer a buyer's lounge in the historic wing of the pavilion if you need somewhere to take a little break during the show. And if you're looking for lunch, there's a few different options. We will again offer the food trucks located in the courtyard. Here's a list of the trucks that'll be here each day from 11 to 3 p.m. The Southern Smoke Shack is a barbecue truck. Pita Delight offers Mediterranean fare. And then Home Slice Pizza and Taco Brothers are pretty self-explanatory. So that is one option. And then we also want to remind everyone that the String and Splinter Club, located in Market Square, is open to non-members during the show. And so you can go in and sit down for lunch Monday, Tuesday, Wednesday, or Thursday. And then they'll also be offering dinner on Thursday evening. Again, that's open to anyone attending the show. And just want to highlight, I mentioned our Virginia Jackson Design Competition, which is an initiative through our ITA Educational Foundation. But we offer a lot of other opportunities for our members through the Educational Foundation, including scholarships for ITA members or the children of ITA members looking to enter the industry. We provide support to our member companies for internships. We have been looking at an international internship opportunity through the Educational Foundation. And we're excited this year to reintroduce our industry tour, where we brought in almost 40 students from schools across the US and took them to a mill, a furniture manufacturing facility, gave them really an inside look at the industry. And so there's some great initiatives through the Educational Foundation, and would be happy to share more information about that. And before we move on to our speaker, just a reminder of our future show dates. Our November show will be the 18th through the 20th. And then the dates for 2026 include May 19th through the 21st and November 17th through the 19th. With that, I'm going to turn it back over to David.
So just before we move on to Mark Bittner, if anyone has any questions, please put them in the chat. We're happy to answer them. I've already answered a couple of some people that have put questions in the chat. One of them, I got a few of the same question concerning the tour on the second floor. Anyone who wants to join can join us. Carrie will be sending out an email to all the member companies that are on the pavilion floor, that if you want to join us for that, you could join that. Join us, and she's going to send an email out offering the opportunity to sign up for one of the tours. But if you have any questions, please put them in the chat and we'll make sure they're answered. Now I will introduce with honor Mr. Mark Bittner. Mark is the founder of Piedmont Crescent Capital. He is a seasoned economist with well over 30 years in the investment banking sector, working at prestigious companies like Wells Fargo. He's authored numerous economic reports. He is the co-founder of the Charlotte Economic Club. He currently serves on the Joint Advisory Board of Economics for the Commonwealth of Virginia. He's appeared on CNBC and other networks. So we're honored to have Mr. Bittner with us. He's going to talk to us about what's ahead for the U.S. economy with a concentrated focus on the home furnishing sector. So like I said earlier, he's got much more intelligent things to say than I do. So Mark, please.
Thank you, David. I am going to share my screen, and hopefully I can live up to that billing and get this presentation deck up there without too much trouble. I'm always amazed when it works. There we go. I have a ton of slides. I'm going to go through the material kind of quick. There's a lot happening in the economy, and for a change, a lot of it has been better news. So that's good. But just kind of the quick little 4-point outline here. The economy has lost momentum. even with the better news that we got on trade this weekend. There's no question that we lost momentum, not as much as that 0.3 of a percentage point decline in GDP in the first quarter would indicate. We had pretty strong consumer spending in the quarter, particularly when you consider that January was a horrible month because of weather throughout much of the country. Uh, and so we also had the fires in LA, and that got us off to a really weak start. And then we had a late Easter, which pushed a lot of what would have occurred in the first quarter usually into April. So that hurt consumer spending. But then of course we had the tariffs, the lead up to the tariffs, and even though April 2nd marked Liberation Day, a lot of businesses were taking precautions ahead of the tariff announcement, and we pulled in a huge amount of imports. And the way the GDP numbers are put together, you add up everything consumers buy, you add up everything businesses invest in, and everything that governments buy, and then you subtract out, you subtract imports and add back exports, and that's supposed to measure production in the economy. And imports surged by so much that they sliced 5 percentage points off growth. So if imports hadn't grown like they did, instead of minus 0.3% growth, we would have had 4.9% growth. It actually sliced 5.2% off of economic growth. So it's a very misleading number. There's a little more to it than that, but suffice it to say that the underlying momentum in the economy is still around 3%. And it's one of the reasons that we were very cautious during all the recession talk, is saying, I still think it's a better chance that we avoid a recession this year than we have a recession. Now that they've got a 90-day reprieve with China, where tariffs were essentially raised to a level that would have shut down all trade. And not only is there a 90-day reprieve, I would caution anybody from listening to anything on CNN or Fox or any of these cable networks in regard to this. They're just totally off base. The only cable network that I think has anywhere close to reality is CNBC. Everybody's trying to say, "Oh, the president caved," or all. There's no. The political intrigue is something to the other. The important takeaway from this weekend is that China and the U.S. have agreed to work on reducing trade tensions and addressing some of the Chinese misdeeds in regard to international trade. And that's the important thing. China has agreed to address some of the grievances against their trading practices. And so at the end of the day, tariffs are higher against China than they were at the start of the year. China's exports, tariffs on U.S. exports are at 10%, on or tariffs on Chinese imports are at 30%. So, I think it's an improvement. The markets sense that tone. We've seen a number of folks come off and back off their forecast for recession this year. I think that second quarter economic growth is actually going to be pretty solid. We've got a 2.5% growth rate in there. We still have weaker growth in the second half of the year, but that forecast was made before this weekend's announcement, so it'll probably be raised a little bit. The second point that I have on there is that consumers are still suffering from inflation fatigue and the lack of affordable housing. They were the biggest issues in the 2024 presidential election. There's still very big issues today. We are beginning to see some relief. Grocery store prices fell 0.4 of a percentage point in the latest in April. It was the biggest drop we've seen since right after the pandemic, and inflation is down to just 2.3% year to year. So we're beginning to see some relief there. Apartment rents are beginning to moderate. That's been a big problem area in the way that inflation is measured. We are seeing a little bit of progress on housing affordability, and the home price appreciation is slowing. But it's not just about the price. Mortgage rates are higher, property taxes are higher, insurance is higher. the cost of owning your own home is just out of reach for a lot of folks. And for that reason, a lot of folks are staying in apartments. And even though anywhere you go, particularly in the southern part of the United States, it seems that they're building apartments on any land that's available. The demand for apartments has been holding up relatively well. And I think the apartment market is probably seeing the peak in vacancy rates. People are staying in apartments for longer. That's shifting attitudes towards how people are buying furniture. It does skew people more into the IKEA kind of mindset where they're trying to make the most efficient use out of the smaller spaces. Because one of the ways that they made apartments more affordable is that they've made them smaller. There was an article in the Wall Street Journal that was dealing with what people want from apartment communities today. And what they want from apartment communities today is they want them loaded with amenities in the common areas, and they want a relatively small living space. So hard to put a whole lot of furniture in a relatively small living space. Thank goodness we got flat screen TVs, because that certainly freed up some room. In terms of single family housing, the spring home buying season has been a bust for the most part. I do think we're going to see a little bit of improvement. Consumers are beginning to get accustomed to interest rates where they are. One of the things that I like to tell people is that it's kind of an unfortunate thing, but I said, if you don't hear anything else in my presentation, mortgage rates are actually relatively low today. And that in the next 10 to 15 years, you're going to say, wow, I wish I would have grabbed a mortgage when it was at 6.75. 6.5 to 7.25 is probably the range that we're going to be in for the foreseeable future. It will be lower than that if we go into recession. It'll be harder to get a mortgage in that circumstance. Now, the last point that I have in here, the outline, is that the trade battles that we're seeing today, while Trump is heralding this, it's not the U.S. alone. The U.S. is merely leading the way. The U.S. is the largest and wealthiest consumer in the world. I mean, there are wealthier little nations in the Gulf, but we're the large nation in the world, and so we're the largest consumer market. And so it makes sense that the U.S. is leading the charge here. The driving force behind the trade battle is that living standards for the middle class all over the world, but here in America certainly have been stagnating for some time. And there are some folks who look at our trade arrangements and blame that. I personally think that's part of the problem, but it's not all of the problem. And it is we've been a little bit on a exercise wheel, or an exercise walker, where we're not really making any progress. And that China has a huge trade surplus with us, either directly or indirectly, because they may transship goods through Vietnam or Mexico or Canada or some other country. But they take in all of these dollars from the United States, and they use them to buy our bonds and lower our interest rates. And it frees up a little bit more spending power for us to spend more money. It's a very unsustainable cycle that we've been in, and it's probably ending now. A couple of things that are going to come out of this little trade battle is that 10% minimum tariff is likely to be in place on every country that we do business with. The way the president sees this, and whether or not you agree or disagree, it's the way he sees it. The way that it's going to be enacted is that access to the United States, the U.S. consumer market, is valuable, and it shouldn't be given away for free. And no one in the world would be able to trade anything if it weren't for the United States Navy. And they're not paying for the United States Navy. And so they're going to keep a 10% tariff. It's not going to go away, although they're going to keep a minimum tariffs. It might not be 10%, maybe it's 8 or 7.5. I think it's going to be 10, but that's likely to stay in place. The reciprocal tariffs, I think that was probably a step too far, but it is that they are going to be used to negotiate deals with large trading blocs after China will probably see a trade deal struck with the EU. Going to go quickly through some of the charts. I want to make sure that we have time to take plenty of questions. This is the recent trend in GDP. While GDP declined 0.3 of a percentage point for the first quarter, it was the advanced GDP report. It'll get revised again at the end of this month. It'll be revised again at the end of next month. There's a good chance that it'll be nominally positive. If you think back to 3 years ago in 2022, we actually had 2 quarters of back-to-back declines in GDP. One of them has now been revised into positive territory. Even if we were to have back-to-back quarterly declines in GDP, if it was solely due to a worsening in the trade deficit, that would not be sufficient to label that a recession. And we don't think we're going to have that. I think second quarter growth is going to easily be 2.5 to 3%. In terms of the tariffs, I've got a number of charts here I go through very quickly, but our first trade battle was really with Canada and Mexico, which surprised a lot of people. One of the reasons the president decided to start there is that we have a lot of leverage with Mexico and Canada. What this chart shows you in the blue line is that 80% of Mexico's exports go to the United States, and nearly 80% of Canada's exports go to the United States. The red line on here is the share of their GDP that is derived from those exports. It's about 30% of Mexico's GDP is derived from exports to the United States. And for Canada, it's about 25%. Now, you would think, well, wait a minute, these are our neighbors, these are our friends. I mean, we like the Canadians, we like the Mexicans. What on earth are we doing here? One of the things that has happened is that China has been setting up operations in Canada and Mexico, or they're sending them semi-finished products, which are finished in Canada and Mexico, and then dumped into the United States. And Trump's just not going to deal with that. He's going to slap a 25% tariff on it. That's just going to be the way it's going to be. You're going to pay the same tariff if you transship it through Canada. And it only affects products that are not covered by the USMCA. And steel is one of the biggest violators. But they were also looking to do EV plants as well in Mexico, and I don't think that's going to happen now. So that was the rationale there. The other thing that stands out on here is that China looks relatively small compared to Mexico and Canada in terms of, and we don't have as much direct leverage over China, but China does ship a lot of product to other Asian nations, particularly Vietnam. And then, of course, they're shipping it through Canada and Mexico, which is why I've got them grouped up there together at the top. Quickly on this chart shows you the share of national income that is going to paychecks or worker compensation. And as you can see how it's been trending down since the 1950s. It's actually kind of leveled off a little bit and began to improve a little bit in the last decade, and then came down following the pandemic. That's the stagnation that we're seeing in wages that's driving all the populism. This is not unique to the United States. It's happening all around the world. It really began about the time that manufacturing peaked in the late 1970s. In the 80s, it was Japan. The Berlin Wall came down in 89. It was the emerging markets, and then it was China after 2000. Just the last couple charts here on tariffs. This shows you how quickly tariffs ramped up with Canada, Mexico, and then China. And then after we had the agreement this weekend, how they've come down. But this is the effective tariff rate on all goods to America, probably going to settle in somewhere around 15% is my guess. And then looking at the impact of tariffs on consumer prices, you can see that for furniture, they're looking probably around a 3% increase in consumer retail prices on furniture, and closer to 4% when you consider the indirect effects. Not the biggest item. The biggest item, I guess, the biggest price increases are going to come on household appliances, many of which come from Asia, and so that have China ties to them, and so that's where you see some of the largest increases. Now, I'm going to shift a little bit and talk about the performance of the U.S. economy. On an overall basis, job growth has been pretty strong. One area that I have a different view than the general consensus is I believe the Fed's going to cut rates probably in July, mainly because the employment numbers are not quite as strong as they appear on the surface. We got a pretty strong number on April, on May 2nd. We got the April employment number showing that we added 187,000 jobs. We've averaged about 157,000 jobs a month over the last year. The way the employment numbers are put together is they do a survey of 550,000 employers. About a third of those get their responses in time for them to compute the number. And then they gross that survey data up to an actual count of jobs, which lags anywhere from 6 to 9 months behind the current month. So right now we have data for hard data through September of 2024. And they show that the pace of job growth is actually about 108,000 jobs, not 157,000 jobs. So we're running about 2/3 of the pace that's been reported. It means the economy's got a little bit less margin for safety. On top of that, most of the job growth is coming from just a handful of areas. About 3/4 of the jobs that we've added in the last year have been in healthcare and social services. So that's hospitals, doctors' offices. It's usually frontline personnel, not doctors, but the administrative workers that have to physically be in the office. Leisure and hospitality, which has mainly been restaurant wait staff, and local government, which has mainly been bus drivers, truck drivers, maintenance workers, people that are out in the field every day. One of the things that all these jobs have in common is they're relatively low pay. Another thing they have in common is you physically have to show up for work. You can't Zoom in 1 or 2 days a week like office jobs do. And they've been the hardest jobs to fill. Job growth in the rest of the economy has been slower. And I think there's a tendency for everybody to look at the top line number and say, hey, the top line number looks pretty good. The composition matters. It's one of the reasons that wage growth has been slowing as much as it has. One of the last charts I want to show you on job growth is manufacturing employment. You can see what's happened when China was admitted to the WTO. I've got it labeled there in 2001. And you can see manufacturing employment peaked. The all-time peak was in July of 1979. It came down in the deep back-to-back recessions we had in the early 1980s, but basically held its own despite competition from Japan and competition from emerging markets and all the automation that we were seeing. It held its own up until China was admitted to the WTO, and you can't argue with that. I mean, here in the Carolinas, we saw manufacturing turn down sooner because NAFTA impacted the Carolinas more than it did the country as a whole. When NAFTA was enacted, the idea behind NAFTA was to create a trading bloc to compete with China. One other way of looking at employment is to look at the unemployment rate. It's relatively low. It's at 4.2%. Wage increases have been decelerating. They're rising about 4% year to year. We still have a lot of job openings in the economy, particularly in the manufacturing sector. We have about 500,000 manufacturing job openings today, mostly in relatively high-paying positions that require no more than 6 to 9 months of trade school in order to or trade school or on the job training in some cases where they have trade schools on site. Looking at the kind of the combination of the unemployment rate and the inflation rate, something that we call the misery rate, it's currently 6.5%, which is relatively low. I put this out there because one of the words that has kind of re-entered the conversation is stagflation, which is the combination of high inflation and high unemployment. We don't have either right now. A 2.3% inflation rate and a 4.2% unemployment rate are both considered low. Full employment is considered to be in the range of 3.7% to 4.2%. That's according to the Federal Reserve. That's their mandate, is to have full employment, and they have a dual mandate to also maintain price stability, which means inflation around 2%. It's currently 2.3%. So I think the concerns about stagflation are a bit overblown. We did deal with a big inflation issue around the pandemic. It was caused by by the just the incredible amount of stimulus that was put in place. We were running large budget deficits, so the Federal Reserve had to buy up the debt that was issued by the Treasury in order to finance those deficits. And we created money. The money supply increased by 25%, and that increased the price level by about 25%. It's now beginning to settle down. Services prices, which are in the gray area there, for services prices, have taken the longest to come down because wages make up the bulk of those costs. As I said, the money supply increased by 25% for the pandemic. If you look at the consumer price index, it's up 23.56% since the pandemic. That's with this morning's number in it. Grocery store prices are up a little bit more, 27.5%. So, pretty much right around 25%. Inflation's a monetary phenomena. That's what caused prices to go up. Prices are up a bit more at restaurants because they're more labor intensive. They're up about 30% since before the pandemic. So, don't want to get through all these. Their consumers are worried about inflation. They're worried about stagflation. The Consumer Confidence Survey asked people where they think inflation is headed in the next year. And with all the tariff talk, it has spiked. That's what the red line is. It's 6.5%. It's not because the price of eggs. I mean, they're atrocious when you go in there. Although I just went into Ingles and got a dozen eggs for $3.94. So it's like that's not the national average, which is $5.19. And I did have eggs yesterday; they were still good. So, but eggs prices are coming down. As I said, grocery store prices actually came down in the month of April. I think that consumers' expectations for inflation, they generally run above the actual inflation rate, as you can see over time. They're generally highly correlated with gasoline prices, which is one of the things that concerns me because gasoline prices have been coming down. My sense is we're going to get an update on the consumer sentiment numbers on Friday, and I think we'll see that inflation expectations will improve slightly. I'd be surprised if they fell more than half a point. But I think that consumer sentiment will increase, and it has been trending lower, as you can see from this chart. Consumer sentiment is the blue line on the bottom. Consumer confidence is the red line. Consumer confidence is produced by the Conference Board. That measure of confidence has been stronger because 2/3 of the survey questions in that survey are related to the job market. And even though the economy is slow, the job market has held up relatively well. So when you ask people, do you think jobs are plentiful? Do you think jobs are hard to get? Or do you think jobs are not so plentiful? The overwhelming majority of the people still believe that jobs are plentiful because they see lots of help wanted signs out there. They are worried that jobs are going to become less plentiful in the next 6 months. However, that's one of the changes. When you look at consumer sentiment broken down by income terciles, the way that they provide it, they break it into three: the bottom third, the middle third, and the top third. You can see how higher inflation has really impacted lower and middle income households, where consumer sentiment for lower and middle income households is actually low today as it was at the bottom, at the worst of the financial crisis in 2008. For folks in the top third income category, confidence had been holding up relatively well. It did fall off somewhat in March and probably fell off even more in April because of the sell-off and volatility that we've seen in the stock market. I do think that'll be very temporary. This breakout has carried over into consumption patterns. I mean, if you look at what's doing well right now, it's the upper end. I mean, with middle and lower income households struggling, they're struggling primarily because food and housing costs have increased so much that's left them with less money to spend on everything else. Upper income households are faring better because higher inflation has an offset. It raises asset prices. And so it raises the value of homes. It raises the value of stocks. And so they have felt a little bit better. They've continued to spend. Home sales have held up better at the upper end. And at the upper end, you have more choices than you do at the lower end. At the lower end, you're looking to upgrade your housing, get a bigger house, get more living space. At the upper end, you're probably living in a pretty nice place already. And so the decision is, do I move or do I renovate? And what a lot of people are choosing to do is renovate, or at least update or renovate. Um, Most popular renovation has been to add more outdoor living space. I think it's an outgrowth of what we've seen from the pandemic, where people wanted to spend more time at home and are looking to entertain more and add more space, outdoor entertainment space. And so the casual furniture has benefited from that. It's held up better than the other parts of the furniture sector. In terms of what's ahead for housing, you look at the consumer sentiment survey, the proportion of people that feel that it's a good time to buy a house is near a record low. And the proportion that feel it's a good time to sell a house, it's not low, but it has fallen off in recent months, mainly because of higher interest rates and concerns about the overall economy. Retail sales, as I said, actually did okay in the first quarter, and they gained strength as the quarter progressed. We're going to get a retail sales number this week. I want to give you a heads up on that. Retail sales are a quirky little economic number in that they're adjusted on a seasonal basis, and they're also adjusted for a holiday day basis. I tell people this and they think I'm joking with them, but this is the way census does it. If Easter comes late, like it did this year in April, they actually assume that people are going to move spending into April and they pull it into March. So the March retail sales surprise people, and it causes people to be less pessimistic about the first quarter. The April retail sales data, I think they come out Thursday. They're probably going to be surprisingly soft. And what I would say is just average the 2 months together. It's because of the holiday day changes. It's the only economic statistic that does this, and the only holidays that matter that move around are pretty important ones: Easter and Thanksgiving. So that's, those are the reasons that they make that change. Just average the two together. When you look at furniture store sales, they're doing relatively well. I mean, this year relative to where they were last year. This is a year-to-year comparison. 3.6% annual rate over the last 3 months. I believe that is, actually that's it's double the what we saw in overall retail sales over the last 3 months. But the year-to-year line has helped because we had a spike during the pandemic. Sales slowed because people bought a lot of stuff during the pandemic, so they could work at home, spend more time at home. And then we had a weak period, and now we're making comparisons off of that period. Furniture sales tend to follow home sales. And like I said, home sales have fallen off. We're actually selling fewer homes today than we did at the low point of the financial crisis. Got a chart here on the 10-year Treasury going back over time. The critical point that I want to make here is one I've already made. While interest rates are higher than where they've been, I think the 10-year is actually closer to 4.40 this morning. They're relatively low compared to where they've been over time. The only time that interest rates have been lower than this was the period between the global financial crisis and where we are now, when short-term interest rates were near zero, and we were dealing with something called secular stagnation. That is no longer in place anymore. Now, the blue line on here is the average from 1960 to date. It includes the hyperinflation period of the 1970s and early 1980s. That's not likely to occur either. But the area within those bounds, I think, is fair game. The period that I think that we're headed going to be most like is the latter part of the 1990s, 95 to 2000. And interest rates during that time period were in the upper end of that band. And so, I warn people that interest rates are likely to be relatively high. Not going to get into all of that. I wanted to talk about housing and then make sure we get some time for questions. In terms of the housing outlook, pending home sales have been trending lower for some time. They did bounce back the most recent months a little bit, but existing home sales, the spring selling season has been a little soft. I will say that I follow it on a daily basis, and yesterday and today, or this morning, we saw, very positive readings. So buyer traffic has picked up according to realtors. And so I do think that the trade deal, even though the interest rates actually have risen in the wake of that, the trade deal and the rebound of the stock market, and taking the recession off the table, I think will help end the spring selling season on a positive note. One of the big problems with home buying is that if you look at the proportion, given the rise in prices, big prices with home affordability, if you look at the combination of home prices and interest rates, it currently takes about 25% of after-tax income. I'm sorry, of pre-tax income. It takes 25% of median household income to make the principal and interest payments on a home. That's higher than it was at the peak of the housing bubble, and that's why housing is unaffordable. And I don't see that improving. In order for it to improve, we'd have to see interest rates fall and housing prices fall. And I don't think either is going to fall. I think that we're just going to have to grow our way out of it with progressively higher income. One of the other issues that we have is that there are very few existing homes on the market. This chart on the left, the dark blue line is existing home sales are right around 4 million. You go back and look at 2008, they were right around 4 million units. New home sales are actually a little stronger than they were during that time period. But you really have to go back to the financial crisis to find a time where we were selling this few homes. It's not to say that conditions today are anything like the financial crisis. The problem today is that we've got a lot of home buyers that have mortgage rates below 5%, and they're not willing to part with their home because anywhere they moved, it would boost their cost of living a great deal. The other thing that is slowing the housing market is that we had this enormous affordability migration where people left high-priced housing markets in the Northeast and West Coast and largely moved to Texas, Florida, the Carolinas, Tennessee, and Georgia. And what's happened is that these buyers came in and they bought up. They would sell higher-priced homes in those high-priced areas, and they were really concentrated in the 500,000 to $1 million price range in this part of the country. And that influx of demand pushed prices up into that price category that there just wasn't that much of a difference. There wasn't enough savings to keep people flowing into those markets. And it also priced out many people and many of the native buyers in those markets. We're still seeing an affordability migration. It's shifted a little bit. It's really shifted into the center south, into some kind of surprising markets. Charlotte and Raleigh are still seeing very strong growth. Greenville's seeing strong growth. Nashville has seen a real slowdown. Chattanooga, Memphis, Birmingham, Huntsville, Fayetteville, Alabama, San Antonio, Texas. Those are the markets in the South that are seeing the bigger influx. Just about everybody else, including Austin, has seen things slow. And so the South still accounts for the bulk, about 70% of all new single-family homes, single-family and apartment homes. Let me tell you one other thing here that's changed. About 8% of the single-family homes that are built today are built for rent, and renters furnish single-family rentals differently than they would furnish homes that they own. They tend to even if they are middle upper income, they tend to furnish their homes using more furniture that I would say is more temporary or disposable. So they tend to buy furniture that they don't intend on keeping for a very long time. So it is because it goes along with their thinking on the house, and that what we're seeing with single family rentals is they work for a lot of people that move around in their occupations for quite a bit and are not committed to an area, and also people that move to an area and might rent for a year or two before they buy. So it is a different mindset. It's a permanent feature in the housing market, and you can see how it's risen really since the financial crisis. to where in some quarters it's actually 10% of the homes that are being built. Home prices are rising a little bit less rapidly. We're expecting prices to rise around 3.5% this year. If you look at residential investment and break it out, the category that I like to point to is the one in green. That's the improvements. And improvements are showing a great deal more stability. They're trending up quite a bit. And if you look at the remodeling index from the NAHB, Westlake sponsors it. It's a little misleading because it begins in 2000 and remodeling activity kind of hit an all-time high during the pandemic. And so the current levels, any reading above 50 is positive. Current conditions are at 71. Future indications at 55, though, and folks are beginning to worry that things are going to slow a little bit. I'm going to stop there. I've got charts on the commercial real estate market, the apartment market, the stock market, and then just kind of state population trends where people have moved this past year, and also where growth has been on an MSA basis, where it's been over the last 4 years, and it's mostly in the South, and then got our forecast going out through 2026. So let me stop there and throw it up for any questions that people might have.
Thank you, Mark. Let's see, if anybody has any questions, feel free to unmute your mic or add a question to the chat. Let's see.
Well, Mark, I mean, the biggest question I would have, I mean, and thanks for joining us today. Some of us have heard you speak at the ICFA and welcome you back. But really, this last chart of what you see happening in calendar 26, a lot of great info for what we got us up to this point and as of today or yesterday. But what do you see for 26 happening with the economy, and how do you see this all faring out? Obviously, the tariffs leveling off to whatever that number would be, but what do you see economically for 26?
It's a good question. Good way to kind of take this more forward looking. And I was a little surprised when I saw a lot of people backed off. They backed off. They went from saying, "Oh, recession next year, nearly a sure thing," and they took it down to 35%. And I was like, one of the things that gives me some pause is that recessions are they're a natural thing. What causes recessions is that we go through good times and people let their guard down. They take on too much risk, and we build up excesses, and then something causes risk tolerances to be reduced, and everybody heads for the exits at the same time. So it's a natural cleansing. We typically go 5-6 years between recessions. We've had 2 months of recession that occurred during the pandemic, during 2020, in the last 15 years. And so, I'm a little worried just about where the economy is. If we avoid a recession, and from a political standpoint, I would think that it's certainly in Trump's interest to avoid a recession, because if the Republicans lost control of the House, he probably wouldn't be able to get anything through in his last 2 years as a president. So I do think that he's going to do everything within his power to keep the economy rolling. I don't think we're going to have a recession. I think that if I was to adjust these numbers post the trade deal, maybe they'd be 1.5 instead of 0.8 or 1 to 1.5 types numbers. Next year's growth should be a little bit better. I think we probably 2.5% growth next year. As long as something doesn't blow up on trade. I mean, that's kind of our big risk, is that, and I don't think it will. I think that the Chinese and the Chinese realize they need America more than they may have been willing to admit, and the United States is realizing that, gosh, we can't go cold turkey and just not import anything from China. After 20 years of our largest manufacturers shifting their production base there. Along those lines, interest rates. The Fed probably going to cut rates twice this year, maybe one more time next year. So the federal funds rate's 3.5 to 3 3/4. probably stays there through all 2026. But I think long-term interest rates rise a little bit. And I don't know that we get to 5%, but we're probably going to be somewhere between 4.5% and 5%. And mortgage rates are probably going to stick right around 6.75%. I don't know that they move from there. It would be slow growth, but it would be 2026 would be a better year than 2025. And I think it would be free of distortions. I'll say that one other thing, though, related, because I started off there with the politics of this, and I always like to tread lightly there. I know that people are sensitive to it. I drove by a Tesla dealership the other day, and everybody was, I saw all the folks out there, and I'm not, I really believe that what's happened this weekend, one of the reasons the markets reacted as favorably as they did yesterday, and I worry that maybe they may have overreacted a little bit, but I think that people realize that Trump's a media personality. He has good media instincts, and he does a lot of things. The way that he operates is he pushes the envelope way beyond anybody would ever think. And then when it comes time to making a deal and it comes much closer to reality, it looks like he's caving when in fact he's actually made a better deal than anybody thought possible. So, both people end up being right at the end of the day. I think people realize that that's where we're headed from a policy standpoint, and there's likely to be less volatility in the financial markets now that people are beginning to become accustomed to Trump. And he's a change. He's not he's probably a once in a lifetime type of political figure that comes along.
Mark, I have a question. Whenever in the past, when we looked at these economic outlooks, the percentage of debt versus the GDP was always a front and center conversation. And not just you, but all the economists you see on whether it's CNBC or any other network or the Wall Street Journal, they barely talk about it at this point. But yet it appears from a layman's point of view that our government still has not adopted the discipline to control the debt or the rise in debt.
Yeah, I get what you're going at there. I wish I had a way of saying this. I tell you, it's sort of like I tell people that the debt is like blood pressure. It's like your blood pressure. It doesn't matter until it matters, and then it's too late. And but there's nothing that talking about when economists talk about, there's nothing that we can do that can bring about an outcome there. Japan has a much higher debt level relative to their GDP than we do. It's about twice as high, but they have a much higher saving rate than we do. And so when we have large deficits, when we have large fiscal deficits, we're running a huge one right now, probably $2 trillion this year. Then we have to, that actually requires, unless we save, it requires us to run a large budget deficit. So in order to finance our budget, it requires us to run a large trade deficit. In order for someone to buy our treasury bonds, they have to get more dollars from us than they spend on stuff from us. So they have that money to buy the treasury bonds. And that's what's going to make solving the trade issue very difficult, and that incurs cost. So when people say, well, gosh, economists have been saying that the deficits are unsustainable, they are unsustainable because we have large budget deficits, we have large trade deficits, and it's hollowed out middle America. It's the reason why communities in North Carolina and Ohio and Alabama and Indiana have struggled as much as they have. And it's why at the start of this I said I'm not so sure that the trade deficit that putting a tariff is going to correct this. It will correct it in one sense. It won't be useless in that it's another way of raising taxes, and so so it will help reduce the deficit some way. But unfortunately, I don't see the deficit situation getting better. In addition to the trade war, I mean, and one of the things that we've got to, China has been acting more and more like an adversary than just a strategic competitor. They've been very aggressive in the South China Sea, and their navy is growing very rapidly. It's very tough for us to keep pace. Our shipyards, we don't have the capacity to build ships like we used to, and we're going to have to spend a lot more money on defense, and so that's and that's in the president's latest budget. I think it's $1 trillion defense budget. It's kind of a phenomenal increase in defense. So I don't see the deficit situation getting a whole lot better anytime soon.
Thank you for that. See if anyone has any additional questions. Certainly would thank you for taking the time to be with us today, Mark.
Well, I'll tell you on the last page of this handout, if you want to get our reports or go to our website, there's no code or access code or anything. You just go and the information's there. There's no charge for any of it. And you know, I usually put at least one report up each week. So there's at least one new piece of information up there. Now, but I don't want to end it on the down note on the deficit. I will say that as you know, the question, but the prior question, right now, I'd say that there's a much better chance the economy grows over the next couple of years, and I see the consumer actually doing a little bit better. And you know, if there's any room for an upside surprise in the economy, it's in housing. We've had a shortage in housing for some time, and I think it is among major industries in the U.S. It's more domestic than just about anything else, and it not as domestic as it used to be, but still more domestic than about anything else. And I think it has a big follow through to the rest of the economy. It's kind of the traditional economic driver. And if there's something that could give us an upside surprise in 2026, it's that mortgage rates stay relatively low, and we continue to get some forward momentum there, and that carries through to everything else. Most importantly, more furniture sales, and also, you know, some of the other items, more hotel business and more hotel development, and more people flying, more people buying cars, and so all the things that textile products go into do a little bit better.
Well, I appreciate you ending on that positive note, and hopefully that inspires everyone to select lots of new textiles next week during the show to put on their new collections. But again, thank you for joining us, and thanks to all of our members and the buyers attending this meeting. If you have any questions, please don't hesitate to follow up with myself or David. And you know, we're here to help. Thank you.
Great. Thanks,
Bye.
Mark. Everyone.
Thanks.